already fragile system before you're ready. I think it was just
Yeah.
buying time.
No, it is. And it's quite a smart approach. I mean, I'm not so happy that all the truck drivers have been stuck in Kenya. But it was a smart strategy. I mean, you know, you're holding all of the truck drivers going across the border. And let's face it, I mean, you know, Tanzania have been possibly a little bit fragile for all of us, especially those that are quite close to us. So it was a very smart approach, you know, your number, because the informal sector in Uganda is huge.
Yeah.
Well, Melissa, I don't know if you read, but COVID has been eliminated by in Tanzania.
Yeah, of course it
Yes,
has. It was never there, Hillary.
And they didn't do anything, did they? There was no lockdown at all there.
No, he said, Magufuli said they traded away.
The Nobel Prize is for Uganda.
And Tanzanian truck drivers, just when they reach the Ugandan border, test positive magically, because clearly the country is
it's bizarre.
Maybe they got some of that Madagascan honey. Was it Madagascar?
Yeah, they did. They imported it.
Yeah,
they imported it.
They did too.
Sounds like Jamaican ganja to me.
Ganja would probably work better than the Madagascar honey, Brian.
Yeah. Oh, funny. Very funny.
One thing for sure is we've got to keep a sense of humor, otherwise we would really be in terrible trouble.
Absolutely.
Yeah, definitely.
Xavier, I loved seeing the beautiful videos of people going out on their balconies at 5 o'clock or whatever and singing, and it was beautiful in Paris. It was really beautiful. Were you out there singing, Xavier?
Sorry, I'm based in Paris for the moment, France.
Yeah, so that's where they were singing, apparently. I guess people at 5 o'clock in the evening were going out on their balconies and playing music and singing.
Exactly. Now this movement stops because we try to go back to the new normal.
Yeah. Whatever that is.
Yeah. We try to back at work, but the city is a little bit dead. It's very calm. You don't have any traffic jam. It's just surprise. It's strange, very strange period. We get more freedom, but you don't see anyone in the street.
Yeah, that's bizarre. That must be very strange.
Especially, I think I saw like a photo. I don't know if all of us have actually been to Paris, but I saw a photo of like the around the Arc de Triomphe, and there's just nothing. Like there's nobody, which is obviously not normal.
Really?
Yeah.
Crazy. And there's Grace.
Yeah, exactly. And the new step for you.
Hi everyone.
Hi Grace.
Hi Grace.
Hi Grace.
Hi, how are you doing?
Good, how are you?
Good, thank you.
Sometimes they come to the office.
Oh, okay, Xavier. So we can start in another 2 minutes.
Okay.
Where are you based, Grace? Very quickly.
Grace?
Yes, pardon?
Where
are you based?
Sorry, I'm in Nairobi.
Okay, welcome, Grace. Just a few words before to start live. I would like to you make a short introduction of each of us with your title, your company, what you are doing, your position, in 2 minutes each, and we'll start with the first question. I will ask you what does it mean financial inclusion for each of you. Maybe you get all the same definition, but maybe not. This is what looking for to know, and you get more or less the question, and feel free to share insight, example on what you did in your company, what you want to do, what you plan, if you can publicly state. So feel free.
Good. Very good.
Apparently, we are live in Facebook.
That's what I just saw as well. I was like, oh, look, we're live on Facebook. I feel like a celebrity. Should we start doing autographs?
I should have dressed up.
Yeah. Sorry, I actually went and put a bit of face of makeup on. I was saying to the guys, I haven't done my hair for about 3 days. It's like, oh, I better actually brush my hair and do my hair today.
It's too cold in Nairobi today to bother.
Oh, isn't it?
Well,
It's
cold in Nairobi is what, about
freezing.
27 degrees?
No, it's like 10. It feels like it's about 10. It's probably about 26.
It's around 18.
Yeah,
18, which is cold.
Yeah,
Well, we're the middle of
exactly.
winter and it is 20 degrees, so we can't really complain.
Oh,
Yeah.
nice.
Yeah.
It's probably warmer here than it is in gay Paris, and it's middle of summer there.
Brian, where are you?
Johannesburg.
Oh, yeah.
Mm. And you, Melissa, where are you?
Thika. So I'm in Nairobi, per the border.
Oh, okay.
Yeah,
Uh-huh.
but I'm actually like, yeah, quite far north. So in Thika.
Okay.
Hmm.
Rashmi, in Uganda.
Mm. Brian, I think the worst lockdown of all must be in South Africa, given that they didn't allow you to buy alcohol.
Well, they fortunately lifted that a week ago. Unfortunately, I'm not a smoker, but cigarettes are still banned and tobacco products. So it's created a massive black market where the price is literally between 10 and 20 times what it was. And the insanity is the government's getting no taxes from the sale of cigarettes. So I know a lot of smokers. It hasn't impacted them at all, except that it's costing them a lot more money. But I think at the low end of the market, this is the tragedy. I don't know if any of you have been smokers, but it is a very addictive habit. Their families are doing without food while the people are spending exorbitant amounts of money on cigarettes. So I'm not sure about the logic behind it, but there's a lot of things that I think the first 3 weeks of lockdown, everybody was very supportive, very understanding, and sort of complied as much as they could. We're now into week 12, and yes, there's been an easing, but that in itself has had some interesting issues just in the nature of work. And one seriously questions, we've been incredibly productive. People are saving at least 2 hours a day out of traffic where they're working instead of sitting in traffic. They're saving a lot of money in transport costs. And the question is, why do we need to go back to an office?
Right.
I think I was saying to Xavier earlier, one thing for certain, we don't know when it's going to end or what the outcome is going to be. But the new normal is not going to be what it was. That's for sure.
Not at all. Yeah.
Yeah.
Totally agree. I think here in Kenya, unfortunately, what we're seeing is, you can't lock down places like Kibera, right? That's just not possible. People, if they can't work, they can't eat. But you are seeing, unfortunately, an uptick in robberies, street robberies, things like this, which is really unfortunate. Just, some folks taking advantage. And that just then puts another kind of pall on anyone wanting to go out and try and, figure out what their new normal is. So I don't know, Grace, if you've been, or Melissa, you've been hearing about that as well.
No, unfortunately, I don't know whether it's unfortunately or not. I feel a bit disconnected by not knowing about it. I feel that we're a bit more isolated here in Thika, but what we are seeing is, and a few of my work colleagues, obviously people are taking a few drives, which they didn't normally do, just to sort of like get out. And what some of my friends are observing, even in as far as like Thika, and then as you go a bit further out, is that we're getting a lot more people from Nairobi, because obviously Nairobi has locked down a lot more than as you sort of go out that greater Nairobi area. So we're sort of finding, that different areas, my mother-in-law, as I'm sure Grace, the same, you've probably got family in the rural, they've got no idea that the rest of the world is locked down. You know, so when they can't get access, you know, like my mother-in-law is not well, she can't get the medicine because she's on one side of the border and the medicine's on the other side of the border, and we can't get, like, and if we try, and yesterday, thankfully my husband has a bit of free movement because of what he does. But he was saying that the other day people were being arrested for trying to persist for why they needed to get through the different borders that they've got. So apparently the police are getting a little bit aggressive on the borders now as well, by arresting people that are really persisting that they need to get through. So I think even I think everywhere would be experiencing the same. I think the further out of the metropolis you go, life is just a bit more normal than what we're experiencing closer to the metropolises.
Yeah.
We can start.
Great.
My dear Paulinist, so just to remind for the last people who join us, we will start in a few seconds. I just ask you to introduce yourself, your company, your position, and your title, and you can start a little bit about your company, 2 minutes each, and we will start with the first question. So let's go.
Shall I start? I'm the thorn between all the roses, so let me start. Firstly, thanks very much. Thanks for having us along, and great to see so many participants, many old friends. It's great to have you join us. Thank you. I'm the CEO and co-founder of Wizit. We launched in 2003, 2004. And we're really pioneers in the financial inclusion space through the use of technology. The thinking back then that the traditional bricks and mortar model of banking people was just too expensive and really not an ideal vehicle to get to the lower end of the market. And I think we were one of the first to prove that A, there's a need at the bottom end of the market, but B, that you could build a model that was certainly sustainable in banking the unbanked. We are very proud of the fact that today our model is used across 4 continents, 14 different countries. We've impacted the lives of around 12.5 million people, and we are on the verge in this month of doing our 1 billionth transaction. So I think we've got a lot that we can add value to this conference in. The world has changed since 2004. It's made some progress. Has it made enough? We'll discuss that today. Not anywhere close to it. And we've got a lot of work ahead that we need to be doing, particularly in this new digital world. But we'll touch on a lot of these aspects, and I'm looking forward to some healthy, rigorous debate. Thank you.
Thank you, Richard. Rashmi, if you want.
Sure. Good afternoon from Kampala, wherever you are, and thank you for having me as part of the panel, Javier. So coming to the introduction, my name is Rashmi Pillai. I'm the Executive Director of Financial Sector Deepening Uganda. We are part of the larger Financial Sector Deepening network, which is in multiple African countries. We are an independent financial sector think tank and do tank. We produce a lot of evidence that informs policymakers and the private sector on next generation ideas, demonstration models that can push the frontier of financial inclusion. We also provide catalytic grants that can, for experiments to prove or disprove, how can we push the thinking on savings, credit, pensions, wealth creation, etc. And yeah, we've been in operations in Uganda since 2015.
Thank you very much, Rashmi. Melissa, can you tell us a few words, please?
Sure. Again, same sentiments as my fellow panelists. Thank you very much for inviting us along, you know, to discuss, you know, digitalization in this ever-moving world. As I said, I'm Melissa. I'm the head of Africa for Mazzoni, the core banking system. So a little bit about us, as Hilary would know, Hilary, this has not been planned, but actually Hilary, who obviously will introduce herself, but actually use our software. So we tend to have a pocket in a lot of different industries, not just within MFIs, but within similar industries to what Tula do. you know, even a crossover into Uganda, Rashmi, with your Tugende, etc. So we don't just look at MFIs and SACCOs, but we can also encompass other industries as well, where they're doing a loan setup scenario. And we're similar to with Brian and Wizard. We sort of look at ourselves as somewhat a bit of a pioneer within the digitalized world, simply because Mazzoni started itself as the MFI, which is still operational in Kenya. We still have the same name. I don't think either of us knew that we were going to be as successful as each other was, because one of us should have really changed our name, but that's hindsight. So our co-founders actually started the MFI, and the MFI started as totally digital. So everything about the MFI has always been digital. And then about 7 years ago, we bought ourselves out of the MFI and started marketing and branding the software as our own. So we're now across 100 different countries within the world. And as I mentioned, you know, various different industries across the world. So we get to see a lot, you know, and we really try to, you know, really get to know our own customers. So we're very hands-on. So rather than, you know, some of the other softwares out there, not just core banking, but softwares in general, you know, they sometimes lose touch with their customer. So we try and make sure that we're constantly evolving based on what's happening in the market, what's happening with our customers, and how various different industries work across the market. So
thank you, Melissa. Grace, if you can say a few words, please.
Thank you, Xavier. And just to echo again my panelists, thank you very much for having me. I am Grace Njeroge. I work with KPMG, mostly implementing the MasterCard Foundation Fund for Rural Prosperity. So the fund is a $50 million fund that has been given by MasterCard. Financial innovation, financial access, and scaling of financial products across sub-Saharan Africa. So we are a 7-year fund. We are in our penultimate year. We wind up next year. So we've already committed most of our funding to financial institutions, to agribusinesses, to fintechs, to different players in the financial services sector in sub-Saharan Africa. We currently have 38 companies, of which Musoni Microfinance in Kenya is one of our grantees. And the 6 years we've just managed to we've committed most of our funding, as I mentioned, and we've already managed to reach that 3.2 million customers through the financial services that we've created. So the goal really is to increase financial access to rural populations, particularly smallholder farmers. So within our grant funding, we really make sure that the innovations that we're supporting within the companies are majorly going towards the rural population, because when you look at the statistics in most, if not all countries, we see that as much as financial inclusion is increasing in different countries, the populations that are being left behind, one of the populations is the rural population, mostly because of the access, plus other issues that we may talk about. So yeah, in a nutshell, that's about the Fund for Rural Prosperity. Thank you.
Thank you very much, Grace. Hilary, please.
Thank you so much, and thank you for the invitation. So picking up on Grace's introduction, Tula is a platform for smallholder farmers. Currently in Kenya is our market where we focus. I am the founder and CEO. The platform aims to provide access to inputs on credit for smallholder farmers at the point of sale, and to help them to market their crop at harvest time. So very much in line with what Grace is talking about, we focus a lot of our time and energy thinking about the challenges that particularly rural people, farmers and small businesses in rural areas, the challenges they face in being able to access a range of different products and services, but particularly financial services to enable them to grow their businesses. We launched 3 years ago, so we're still, I joke, we're like a toddler. We, you know, we're mobile, but we don't have much common sense. But hopefully with each day, we're gaining more and more. We have about 27,000 farmers on the platform now, and looking to scale that up in the coming months and years.
Thank you very much, Hilary. Let me introduce myself. My name is Xavier Gomez. I am the co-founder and COO of Invio. Invio is a market intelligence platform dedicated to financial services. We offer a SaaS solution that leverage proprietary big data analytics and natural language analysis, NLP, to help financial institutions drive their digital transformation strategy. We provide to our client predictive analysis, sourcing, market intelligence, and competitive intelligence tool, and we conduct analyze accessible on request to financial institutions such as bank, insurance company, consulting firms, private equity firms, and VC funds. And I am the honor to moderate this great panel. Thank you very much to accept the invitation. And let's start with the first question. Very simple question. What does it mean for you? What is the definition for you of financial inclusion? Who wants to start?
Okay, I don't mind. I'll have a kickoff, and I think it's a very relevant question, because once we understand what is meant by financial inclusion or what it doesn't mean, then we can look at how successful or unsuccessful we're being in addressing it. So for me, a financial inclusion is basically access to financial services, and that is a ladder. It means a safe place to keep my money. It means easy access to my money. It means having digital means with which to spend my money. And it means that I can have access to credits and loans as and when I need them. And we've all had occasions in our lives when we can do that. Whether all of that is provided in one lump shot is open for debate. But I reckon once you fill those criteria, then we can talk about financial inclusion. A person who belongs to a savings club, in South Africa, they're called stokvels. Does that qualify as being financially included? I would hazard a guess not. The fact that I can purchase airtime digitally from my mobile money account, does that mean that I'm financially included? I would probably hazard not. If we had to look at the stats in terms of financial inclusion, almost 20 years ago when we got involved, 3 billion people were financially excluded or regarded as unbanked. I'd like the panel or anybody to answer what that number is today, and it probably does breach into question number 2, Xavier. Have we made any significant difference over the last 20 years? I hasten to say probably not, unfortunately, because that number of unbanked people in the world is still around the 3 billion. I look at Africa, the continent in which we live and love. 700 million people on this continent do not have access to financial services. To me, that is criminal. It really is criminal that 20 years later, we just haven't been able to make a dramatic impact. I'll stop there and we'll pick up on a lot of these topics later.
Can I jump in on that, Xavier?
Of course, go ahead.
I'm going to agree and disagree with Brian. The piece that I will agree with is, I mean, the way that I would define it is not just about access in terms of the numbers of people that have, for example, an account in a bank, but it also goes to, it's a range of services, right? Services that enable them to smooth their income, services to grow their business, to cope with risk, and to save for different events. But at the same time, there is a huge problem, I think, in many markets with inappropriately designed products. If I am a poor smallholder farmer and I am taking a loan to buy fertilizer for my farm at 300% APR, I would argue that is not financial inclusion. That is not a good fit for me. And I take it because I don't really have other options. I would also argue, I mean, we do know that the number of people that are unbanked has actually gone down. So with the population of, call it 7.5 billion, it's about 1.6 billion that are unbanked. And you can see in countries like Kenya, increases year over year of people who are banked. Now, the challenge, I think, becomes all of those markets where there is still a very high level of unbanked, like Tanzania, for example, as well as countries where on the average, there's a high number of people that are unbanked, but those people who are not, we need to understand why they are not, and why is it that we're not able to get the remaining portion of those populations into the financial system.
So just to tag on the coattails of Hillary, so adding to that conversation, I completely agree with Hillary, the number of people who are financially excluded has declined significantly, and today we're looking at 1.6 billion people who are financially excluded. I would refrain from just using the word unbanked, because what we have seen, if East Africa has proven anything, is the store of value can be a bank account, mobile wallet, what have you, a prepaid card, any of that. But what has been challenged is the definition of financial inclusion. And for example, a large part of our initial work as the FSD network, as FSD Uganda, has been around, are we helping people with a bank account or a mobile money wallet? Are we helping them with credit? Are we helping them with insurance? But what we realized, and the initial design of why we were doing all of this is because to help them deal with shocks, to help them manage and optimize resources and minimize risks. But what has happened in at least East Africa that I can speak confidently of is that as the definition, the traditional definition of financial inclusion, as the number of people who access mobile money accounts or your digital credit increased, poverty also increased, which should have been the other way around. But we saw a significant rise in poverty as well, which means the question should have been financial inclusion for what? What is it doing for people? What is it doing for businesses? Is it enabling their upward mobility and their economic resilience? And if it doesn't, then we're clearly designing, the financial sector is not playing its role in helping design better financial services and products that are helping people move up the ladder. So that's how we're looking at financial inclusion.
Yeah, I do agree with Rashmi, just in terms of the definition of financial inclusion. I think traditionally it's always been defined as access, the number of people that are accessing financial products. But as Rashmi says, financial inclusion is increasing, but poverty is also increasing. If financial inclusion is an enabler of economic empowerment and economic transformation, then at least the two should be going together. The financial inclusion should be increasing, but also people's economic well-being, their ability to withstand resilience and shocks should also be increasing. So I think in my opinion, because the question is, what is my definition? I think the definition should be expanded to include not only access, not only usage, but a lot of information, because sometimes the access and the usage statistics are different, and sometimes it's because of information. Customers do not really understand what products there are, how the products can help them. So the definition should be included, expanded to include information, but also transformation, some sort of transformation from using the financial products. So it should not be an end in itself in terms of financial inclusion, but it should be a means to an end. And the end is economic transformation, poverty alleviation, better livelihoods, people just being able to live better lives as a result of financial access and getting access to these financial products.
Thank you, Grace.
I'll just also, obviously, I think we've all sort of said something very similar, and for me, the word is safe. If I had to encompass financial inclusion, as everybody else has sort of said the same thing, it's not just, do I have access to it, but am I using it wisely? Do I understand it as well? And also, I also wonder, and I obviously, I'm not trying to play devil's advocate by any means, but I also wonder with the statistics and the numbers, where the source is coming from with regards to, like the 1.6 billion. Is that, obviously we see a lot from our, with customers, where you might have a customer who's got an account, but the account has got no money and they haven't actually used that account for, say, you know, X amount of years. So is it like, what is the actual quantifier to say that, yes, this is somebody that has that access? You know, and I must admit, I've not done my, what do you call it, research on that. So I'm sort of more speculative. As I said, I didn't want to, Rashmi, you're giving me a very funny look. Which I'm sure with
I won't give you comfort.
No, I was going to say, like, obviously this is more towards yourself because it's what exactly FSD does. You know, in that regard is, you know, are we looking at the right quantifiers? Because, you know, like we see it a lot where you've got a customer that's not a true customer. So are they being contributed to that number or whatnot? But, you know, as the question proposes, you know, what does it mean to me? You know, and it is all of that, you know, what financial inclusion means. You know, I was even chatting with others about it, and everybody's got their own variation of it. So trying to standardize what is financial inclusion is obviously something that is more personal. And I think it also depends on your experience as well, how you look at things and what you've been subjected to in the past.
Thank you, Melissa. Very interesting point of view. You get a 360 view on financial inclusion. You already anticipate my second question because you provide some data and figures about financial inclusion. I don't know if some of you want to complete with some figures about financial inclusion in your country or market. Yes.
Yeah, I've touched on them, but Xavier, and I don't want to dominate the proceedings here, but clearly we cannot ignore what is happening in the world right now, and that is with this pandemic. It seems to have had an impact on the way that people are responding, certainly to digitalization. I've got a massive concern that in this increasingly digital world, it's tragic that it's taken a pandemic to get financial institutions to actually wake up and say we need to do something towards digitalization, but that's a whole different argument. The fact that they are starting to wake up, let's give them some credit to. We're busy with an implementation right now in Central America where we've been given 21 days in which to launch an entire digital platform. Are we going to do it? Yes, of course we are. But I'm saying it's almost a panic and a frenzy from government. This happens to be a government requisition that we've been given, is to say we have got to do something and we've got to do it in a hurry. And we'll be able to deliver on it. But I'm really, really concerned in this digital world. And I talk about Africa, although I see that there are some participants and attendees and delegates from other parts of the world outside of Africa. And it's great to have them on board. But let's look at Africa here. What happens to the 700 million people that do not have access? And I will take issue with Rashmi because I don't believe those numbers of 1.6 billion. And I will still maintain that because I belong to a stokvel does not mean that I'm financially included. It does not give me access to any financial instruments. It does not give me access to any financial services. Yet in our country, they are now conveniently accounted for as financially included because it makes the numbers look good. But that's a whole another debate. I want to launch a product. And if you had to look at any innovation over the last 5 or 10 years, they've been incredibly successful, be they whatever they are, because they have got incredibly good payment systems behind them. If I want to launch anything innovative in Africa that requires digital payments, I must know that immediately I'm excluding 700 million people. Immediately. Not because I don't want to use the product, not because they don't want to pay, but because they do not have the means to pay. And that is a concern of mine, and it reflects in the numbers that says what happens as we are exponentially adopting this digital world. We are leaving millions, hundreds of millions of people behind because their only means of interacting in the economy is with cash.
Thank you, Brian. Something to add about that?
Mine's sort of a bit different. We obviously, I was compiling some some information last night just around our data, which we're quite comfortable to share. You know, as I said, I mean, we've got over, I think it's, we touch in 100 different countries. So I think we've got about 130, 150 customers that we, or clients that we service. So we obviously have quite a global, what we think is, you know, somewhat a bit of a global picture. So a few statistics from us in terms of like how we are, you know, in terms of like standing as it now, we've got 77% of our customers are women. Now, when I talk about our customers, these are our customers' customers. So we've got, I think we just went to 1.4 billion, sorry, that's almost the world, sorry, my apologies. We just exceeded 1.4 million customers within all of our customers. So at 1.4 million, we've got 77% of our customers are women. 58% of our customers live in rural areas. And 70% of them live below what I believe is the accepted, and obviously Rashmi, please correct me if I'm wrong if this number has changed, but what is below the $2.50 US a day poverty line. And we have an average loan size of about US $300. So, you know, we can see that, you know, it is getting better to what it was 5 years ago, with obviously, especially the introduction of like smartphones, you know, better connectivity in rural areas. You know, obviously, you know, it's still not good enough. There should be, you know, more transparency, more access, you know, but obviously with that also the education that needs to come through for it as well. So yeah, so we sort of compiled that.
Okay, so I'm going to just tag along to what Melissa said, if that's okay, Xavier. So it just in terms of the 1.6 billion, the number comes from the Financial Inclusion Index that's conducted every 4 years by the World Bank. And what it measures, it's 12-month, so it measures the number of unbanked people, 1.6 billion still unbanked. The definition of banked is whether you've used a bank account or mobile money account used in the past 12 months. That's the definition with which they measure it. Is that a meaningful definition is something that we can all discuss, because just because you've used a bank or debit card once in 12 months, does that say anything? Does that help you being included? Does that help you move upwards and build, increase your livelihood as a small business, increase your take-home income? Absolutely not. That's maybe necessary, but significantly insufficient as a metric. So that's point one. Now, coming to some of the Uganda numbers that give a sense of the financial fragility of people, because we did that analysis based on the Finscope data that we do, and we collect that information nationally representative every 4 years, where it's, and this is also very useful to compare against Kenya, because Kenya, at a very simple level, has a very high individual phone penetration rate, like 80% and above, individuals own phones. In Uganda, if you talk about the number of unique people that own mobile phones, is 52% of the adult population. There's a big gap there. So people like me will have 2 phones, and each of the MNOs will report them separately. The regulator will add all the subscribers, and nobody's wetting them for uniqueness. And the same people are being double and triple counted. The same goes for mobile money wallets as well. So when you take the fragility of people's lives before and after the pandemic, which is something that we've done, we've realized that majority of the people have very little liquid. So you can look at fragility in terms of how many assets do you have in a worst case scenario, like a pandemic. Do you have liquid cash? Do you have semi-liquid assets like a goat, poultry, whatever that you can, and then you have illiquid asset like a land or something that you just cannot immediately sell. So we took that lens in terms of how resilient could you be in a complete worst case scenario like a pandemic such as this. And what ended up being is the median savings that most people had is 4,500 Ugandan shillings, or less than $1.50. 3 million people were at risk of completely going back into poverty. That's 23% of the adult population. When we did an analysis of how many people could survive a very strict lockdown, which is what Uganda was under, the way we did it, because of course data is not perfect, so you have to make certain assumptions, and the way we did it is, could you sustain your existing lifestyle in a lockdown? And what resulted is 80% of the population would not be able to sustain their existing lifestyle. Whether that's a great lifestyle, very luxurious, is all separate. Within 80% within first 15 days would not be able to sustain their existing lifestyle. That should tell you a lot about how economic activity is happening. A lot of people are earning daily. A lot of, whether they're informal transport suppliers, taxi drivers, or they're just doing regular business. Even if you're a wholesaler, you're earning daily because that's daily trade activity. You may be more resilient than a smallholder farmer. That's a separate issue. But the pandemic just exposed the level, it exposed the level of fragility of people's lives. Second, it tells you a lot about the inequality that exists. And the fact that we need to fix some of those issues that are emerging. Nobody is talking about how can the financial sector help solve the inequality that is leaving people who are already less than $2 a day worse off. And secondly, when you have most of the African countries getting all of the stimulus support from the IMF, World Bank, all of that is being channeled through supervised financial institutions, which is where majority of the people are not. Which means that the small businesses and the people who are living below the poverty line are more likely to not receive any of the stimulus support that is coming through development partners or through a lot of the governments. There is that inequalities, that bounce back is going to be divided into a lot of the segments of the population. There'll be some segments of the population who will just not even come back for a very long period of time, maybe up to 3 years.
Then surely the question, Rashmi, is a very simple one. Why have we got the majority, and it is the majority throughout Africa, of small, medium enterprises not being banked? They do not have the means to accept digital payment. Surely the fundamental question is why? Why are they not part of the financial services system? And it's not a difficult question, and it's an even easier answer.
Why don't you take a shot at it, I can give you a Ugandan perspective why we think that's
okay. And I accept the fact that each market is different, but I would challenge any of us to go out to any small business and ask them, how easy is it for them to open a bank account? Just go and ask that one question. How easy is it to open a bank account? It is nothing short of a flippin' nightmare.
So that was the case in Uganda for a few years ago. Of course, we got a universal national ID for everybody, and that process is improving. I'm not saying it's picture perfect, it's improving. But that doesn't mean banks will lend to small businesses. There is a high, sorry. So as you know, there's a lot of, there are a lot of systemic issues in Uganda, and I'm sure Hillary knows a lot about this because she's worked here for a lot of years as well. So a couple of issues. The ticket size of investments that small businesses need is not very attractive for a lot of the big banks who can then who just largely want to sit back and give big value of transactions to corporates. They don't know enough about small businesses. They want to do traditional way of banking, which is, oh, show me a collateral, and mostly immovable collateral. So land or a building, which smallholder farmer is going to have that? Of course, now FSD Uganda helped in pushing through regulation on electronic movable collateral registry to reduce that information, because even smallholders, or at least there are people who own a small car, a small, boda, like a motorcycle taxi, and that you can use as movable collateral because most of the people don't have immovable collateral. So we try to solve that problem one way. We're also trying to help banks understand how to do alternative credit scoring models. But there's also the bigger issue of the fact that government borrowing is crowding out the small businesses. If government is going to borrow and risk-free rate is giving you 15%, the cost of commercial borrowing is going to be 20%, 22%. That's extremely expensive for most small businesses.
Can I just add to that? Because one of the things that happened in Kenya was there was an interest rate cap that was placed, which had the exact effect that, you know, my first year economics professor would have predicted. That is essentially, if you put an interest rate cap, banks are going to go to safety, right? And they're going to stop lending to customers for whom it's more expensive to lend to. And what we saw in Kenya was about 2.5, 3 years after the interest rate cap was put in place, what happened was the average loan size in the country went up about 37%. The average loan in agriculture went up 56%. So it just means that they all fled to safety, right? They went to the big, larger processors, exporters, flower farms, et cetera, to make those safe investments, further abandoning smallholder farmers who in Kenya, the estimate is about $1 billion of unmet demand simply for working capital. So, you know, you can see that in any kind of crisis, whether it's, you know, imposed by the central bank or a pandemic, the banks are going to flee to safety, right? And so who is there to continue serving these customers? And I would put both low income, rural and urban, and small enterprises in the same bucket.
But I think you also need to loop in, without like going to the lowest level, or that may not be the right terminology, but within the supply chain, obviously, you know, the likes of, you know, your MFIs, etc., they severely suffered from the interest rate capping as well. Because when an MFI, they need capital, working capital themselves, you know, if they don't have their repayments coming in, if they've got a high PAR, they want to lend to customers, but they've got no capital, they've got no disposable cash themselves. So you'll actually find that some of these, you know, agri lenders, you know, your more, what the banks, traditional banks, and look, everywhere in the world has this definition, because it's even in my country. You know, our banking regulations are the toughest in the world. So where they deem somebody sort of unbankable, or, you know, risky, even they couldn't get loans from the MFIs either, because the MFIs get money from the banks to build businesses. Those that could actually put such high restrictions onto, if you want a loan from us, you need to give us this part of your business, this part of your business, this part of your business. So they really went quite aggressive in the sense that if you come with us, we need everything. We're not just going to give you a loan and you just pay it back. We want all of your other businesses as well, which obviously has now put them in a situation where they're at the demand of the bank. You know, they need the loan to keep working, and at what risk that they're taking on just to get this loan. So it's been quite vicious with this capping.
Yeah, I agree, and I think that's the dilemma why like finance is not flowing from the lenders to the people who need it. And I think I'll just give an example of what you're seeing with the fund for rural prosperity, because the fund ideally was developed, and such it's one of such mechanisms that are available just to de-risk financial institutions, because the argument from the financial institutions is that, look, this is not our money, this is customers' money that we then have to lend to these people who we don't understand, who are very high risk. They have to rely on weather, they have to rely on customers, they've not studied their customer patterns, so they do not really know, they cannot even predict the demand of their products. So this sort of de-risking capital, because we give our capital as grants, has really helped in terms of just giving financial institutions the comfort that they're not only investing their money, they're not just putting their money in and they're not really sure of the sort of the outcomes, but we're also giving them some sort of comfort in terms of giving them the money to invest. And then also, I think another thing that's also really, we've seen really helping in terms of this sort of dilemma between the supply and the demand side is just provision of technical assistance. I know there's been a lot of a discussion around whether does TA work, to what extent does TA work, but I think when we look at our portfolio, we've seen that TA really works in terms of just helping these banks to understand the market, because sometimes it's just a matter of some of the financial institutions do not understand the customers. If we bring,
I agree.
Yes, and sometimes all they need is just to walk the customer journey, understand this is a farmer who will not get monthly income. They'll get their income at the end of the harvest season after 6 or 3 or 4 months. And so just walking the journey with them, helping them craft different products. Because again, the problem, if we look historically, the problem has been that financial institutions have not been really offering products that meet the different segments demand. And they've been just offering blanket products that this is a loan product, take it and use it as a farmer, use it as a small business, use it for consumption. And so just providing that sort of assistance to help the financial institutions understand the market, segment the market, customize the market, and then also just customize the products that are being offered to the market has helped. And then on the other side, that's the supply side, but also on the demand side, there's also the problem of SMEs not really meeting the demands of the financial institutions and not really looking at collateral, but also looking at, apart from collateral, financial institutions ask for, we want to see your books of accounts, we want to see, do you understand your customers? Do you really know your market? What's your product meeting? And just so that we can be able to establish the cash flow. So in some instances, we've also seen that TA also works on the side of these SMEs, because sometimes for them, it's also just sort of even like an information problem. They're not willing to open up their books of accounts. They're like, well, we don't want the tax collectors to come and say, oh no, we've not been paying our taxes correctly. So let's not open up everything to the banks. So it's just probably trying to align the market, and providing TA, I think, has sort of helped so far with what we see with the funds for our prosperity portfolio.
So Grace, Hillary, and Brian, I have a controversial question for you, because this is something that we've sort of come to a conclusion that are banks the best placed to serve the bottom of the pyramid? And we feel that probably not, and it's okay. For example, if banks want to say, okay, because of regulatory requirements and provisioning and what have you, it's better for us to just on-lend the money to people who understand the bottom of the pyramid, like non-deposit taking MFIs or SACCOs, you know, like, because they understand group lending better than banks do, or even individual lending, microcredit. It's just better for us to give it to them. Is that a better approach than expecting the unexpected? Because if they're not designed for that, why expect that from them?
Yeah, it's a great question, and it's one that I've been advocating for 20 years. The problem, as we all know it, is that banks are highly regulated entities. The plus side of that is that they do tend to build trust in the marketplaces that they tend to serve. Are they interested and passionate about serving the bottom end of the market? Well, I'm going to go out on a limb and say, if you can show me the fantastic, enthusiastic, passionate driver within any of the big banks, and I'm talking about the big banks, around financial inclusion. I'm not talking about paying lip service to it because it's a politically correct thing to do. I might eat the very table that I'm sitting on. But as a new entrant, and I was asked the question at a competition board of inquiry as to how easy is it to get into financial services? The barriers to entry, Rashmi, are absolutely horrendous. We're going through some certification now on the acquiring side for the SMEs to enable them to have a cheap, cost-effective way to acquire digital transactions. My board is made up of very smart people and chartered accountants look at me and say, Brian, do you know how many millions of transactions you have got to do just to pay for the certification that is set by the various associations and boards? So the costs of entry are absolutely horrendous when all you want to do is to serve that low end of the market, to give them digital means to pay. So it is a dual-edged sword. I do agree that there are other parties that are much better placed to serve the needs of the lower end of the market. But we also need to be very aware that the bottom end of the market is prey to crooks and people who are really maybe not as scrupulous, as honest as we would like them to be. So yes, there is a degree of protectionism that's around. And how do you draw that entry between barriers to entry with a total free-for-all? Not an easy question, but a good question.
Yeah, and I think we've also seen some agricultural off-takers who really want to empower their farmers. So they want to empower the farmers that deliver to them so they're able to produce more. And we have several examples in the portfolio of such companies that try to partner with financial institutions. So that these financial institutions, the banks, can be able to provide services to the farmers. And then the banks are just frankly not interested. So We've seen some companies that have just gone ahead and started lending off their own balance sheet to these farmers, essentially creating their own financial, they're not a financial service provider, but they have taken the initiative because the banks are not moving and they need to empower their farmers. They need to source more from their farmers. And so they've taken this upon themselves. So yeah, I agree with you that maybe, Rashmi and Brian, that maybe banks are not really the people we should be backing up to continue this conversation that has really not taken off all these years.
Yeah, I would agree with that. And I would say one of the channels that I'm particularly excited about, it has challenges for sure, but one of the channels I'm particularly excited about are some of the platform e-commerce businesses where there is a tremendous amount of data. I mean, if you think about some of the food delivery services in Nairobi, for example, these guys who are the couriers on their bodabodas, on their motorcycles, these guys are unbanked for sure, right? There's very little data known about them. They certainly have financial needs. And now suddenly there's a whole lot of data about their daily activities, how many trips they do, how much money they've earned, et cetera. And if you look at companies like Grab in Southeast Asia, they're being incredibly innovative in using that platform and that data to provide everything from working capital to insurance to basic savings mechanisms. So again, you could imagine some challenges around that, and from a regulatory perspective, we have to be careful, but I'm particularly excited about those platforms as a means to unlock financial inclusion.
And I sort of, oh, sorry, Rashmi. Oh, Ta. I totally agree with like Hillary, is that I think, whilst I don't want to say it, I think until banks decide that, you know, they need to catch up, or there's obviously that tendency for banks to follow the profit line. So if they start seeing that there's more of a profit to be made from, you know, looking at, you know, MFIs, SARCOs, and in turn, you know, your SMEs, etc., I don't think they'll probably pay much attention to us until then. But, you know, so for us, it's the same. You know, we make a lot of relationships with different, obviously for us, you know, it's all about relationships, you know, and it's who we can, you know, have a relationship with, you know, like the likes of, you know, FSD and Growth with MasterCard, you know, different associations, etc., where everybody can collaborate and collectively learn of the different challenges, etc., to then, in a term, almost create a totally different supply chain, you know, which will then benefit the bottom end of the pyramid, if we want to coin that phrase today. So it is sort of in making sure that, you know, we do a lot of different introductions to different, you know, as you mentioned, sort of the e-commerce platforms, etc. You know, and we look at different things, you know, on how we can help serve our customers better as well. So we definitely look down that line. You know, we're sort of interested to see what sort of new initiatives also come through from some of the economies where it might surprise you that they have very little digitalization. One of them being Nigeria. The digitalization within Nigeria is almost minus. I was very surprised. I was really surprised to learn, you know, but it's around collectively us, you know, saying, okay, well, we're over here in East Africa. Can we help, you know, our friends over in West Africa, etc., so that, you know, Africa becomes a totally different supply chain away from your more traditional forms of generating services and money, etc.
Yeah, I mean, I would agree, but it goes without saying, and it's a statement of the obvious, e-commerce only works if you've got good digital payments behind it. E-commerce in a cash-based economy, it's been proven time and time again, it just doesn't work, it's too costly to run. Nigeria is a wonderful example where I really went publicly, stuck my neck out that of all the regulators in Africa, they were the most progressive. They were advocating a cashless Lagos, then a cashless Nigeria, all gung-ho around that. And then they come along overnight and they put a limit on USSD transactions because somewhere they got to be in their bonnet that USSD was topic of fraud. We, as I said earlier, are approaching our 1 billionth transaction, and I don't want to tempt fate, but we have not read any fraud on our USSD channel. So you wonder where the information comes from, and on that, they destroy what they've worked so many years to build on. But the e-commerce opportunity is massive. I just want to mention one thing, and we mustn't lose sight of it. An article that I read recently as a result of this pandemic is, whether we like it or not, a minimum of 150 million Africans are going to lose their jobs on this continent. 150 million. Many of them have got loans from banks and financial institutions. There is a terrifying thought that there will be a run on banks, that they are conserving every cent that they've got. So while you've got this opportunity to invest in digitalization and digital programs on the one side, I do understand it from a financial institution's point of view, that there is this almost fear and sense of irresponsibility that says, if we go and invest in digital programs today, what about the pending doom of repayment of loans? So you do have this reality sitting at the back of people's heads, which is a concern. So you've got a great opportunity on the one hand, but it's balanced by a terrible pandemic on the other.
Okay, so just to conclude, okay,
sorry, Rashmi, go ahead, please.
Sorry, I want Xavier to come in because it might be good to hear from your digital
No. This is a nice pleasure to hear you. Go ahead.
But coming back again, just to bring home the point that every one of you has just so beautifully put, is that what we're noticing, and you know, we're okay with the trends that we're noticing, because it just speaks that people are voting with their feet, and it's okay for the market to structure itself in certain ways. For example, when Melissa and Hillary and Brian mentioned platforms, so what we're seeing is that, as Melissa mentioned, Uganda, or you look at Phoenix, which is a solar company, etc. So what a lot of these companies are doing, it both, you know, they have several customers or households that have bought assets, both productive and non-productive assets. And then you start graduating within the company, because the company starts building its own credit score about you, and then gives you more expensive assets. And they now start, most of these companies have got MFI licenses, have got money lender licenses in Uganda, and are now just giving you loans, because we know how risky Hillary is. Hillary paid off her $1,500 solar asset, and we know that we can give her a $200 school fee top up.
Exactly.
And that's like, they are just taking that place that banks are just not designed to fill. And that's okay. And when Hillary reaches a certain value or sophistication, or feels that, okay, Phoenix or whatever this, you know, this level of support that I was getting, I need to graduate because I have become big enough as an enterprise. And this is the time where a bank would come in, or some other type of financial institution, like a deposit taking microfinance institution. That's a graduation process of a customer journey. And that's not necessarily wrong. It is just a very interesting trend that there will be now non-bank financial players that may create much more opportunities, and also something for regulators to watch out, because they could also come with their own risks.
I agree with you 100%, and I'm especially excited about the potential there. I think, just picking up on something that Brian said earlier, you know, the pandemic is certainly going to exacerbate the divide that was already there. I mean, I've heard people talk about the pandemic being more of an accelerant, right, than a spark. It's simply accelerating trends that might have been there already. And when you look at some of the e-commerce platforms, something like 97%, for example, of the couriers in Kenya, either for food delivery or for ride hailing, are men, right? Most of the consumers for platforms like Jumia or some of the ride-hailing services, you don't have people from the urban informal settlements who are using these services, right? So you still then have this risk that the e-commerce companies are going to start playing this really vital and, I think, powerful role in increasing financial inclusion, but you're still going to have a group of people that are going to be locked out. And we have to think about, how do we serve them? If the banks are not going to do it, alternative lenders are not going to do it, right? How do we do it? And so if anyone has the answer, I'd love to hear that.
Well, I do think it is true that competition is going to come from alternative sources. it's often said tongue in cheek and maybe anecdotally, but there's an element of truth in it, that the two biggest banks in the world, PayPal and Ant, don't have bank licenses, have no desire to have a bank license. Amazon probably gives more loans to their small businesses than any bank on earth does. They don't want to become a bank. Banks have lost 25% of the payments business overnight, literally. And one has got to say, where are the banks? And do they want to play in this new world? And if they do, I think they need to start taking a little bit more seriously in terms of the speed with which things are done. A friend of mine opened an account in Europe last night. It took exactly 27 seconds. We are trying to open an account in London through a business that we're setting up, 3 months and counting to get a business account open. The world is changing, and we need to wake up to this reality. This account that was opened in 27 seconds got a spending limit of 150 euros, not one piece of paper. And our regulators or the banks that are hiding behind this regulation is driving us all insane, and we're missing an unbelievable opportunity. It should be a birthright that everybody is allowed and should have a bank account of some sort.
Sure, but then Brian, that's not necessarily a very fair example, and you know that, because 150 euros, what you're saying is then there's tiered KYC, right? So it's like, all right, we've put a ceiling, it's a very low risk account, and
Sure.
we're going to put low risk KYC, so it's proportionate to risk. But if
Correct.
you were going to open a business account in London and saying we want, irrespective of limit, then it needs to be proportionate to risk, because AMS, FT.
No, I'm purely trying to say there was a study done, and I can't remember the numbers, with the high street banks in the UK as an individual account. What it took to open an account in one of the traditional big banks versus one of the challenger banks. And I mean, it's mind-blowing to see the difference with reaction times and speed at which those accounts. So yes, clearly my example but I'm purely using the example of a small business. Forget about loans and facilities, that's nothing else. You need an account to accept transactions. But we're killing the market with bureaucracy.
I'd also like to propose a bit of the question is, does everybody want a bank account? Does everybody want to be banked?
Does everybody need a bank account?
Well, but do they want it? Like sometimes it could be, are we trying to drive something that for some particular markets just isn't warranted? It isn't actually, because it's not what they want. And obviously that's a totally different discussion again, but it's more about like, okay, these people that don't get access to financial means, there's obviously two categories. It's the people that do want to access that can't access it, and then you've got those that could access it, but they've just got no desire to, for whatever reason. Everything they do is cash based, so their need, and you ask a lot of people, especially, people, depending on your generation and your experience, a lot of people like, no, I would never put my money in the bank because I don't trust them. They're all thieves. There is that huge perception across the world around, I want to know, I would prefer to put my money under the mattress and do everything by cash than to risk some big corporate person, and they even include MFIs and SACCOs in that corporate world, because they just don't trust. So some of the question is, are we trying to do something that for people that they don't even want?
Yeah, I mean, Grace, go ahead.
Yeah, very interesting and passionate discussion. I would like to have your opinion also to another aspect of financial inclusion. What are the biggest barriers to financial inclusion today, and how do they differ from the barriers that existed a few years ago?
Okay, sure, I can go, as I probably also piggyback on Melissa's comments. So there are the people who, so she's classified the group into two: people who want financial access and people who frankly are probably happy with their merry-go-rounds, with their groups, with their informal channels, and they don't necessarily, but there's also, out of the 1.6 billion, there's also a segment who it doesn't make sense to bank them because their incomes are really very low. So I've done a lot of market research in terms of low-income people as part of my work, as we just help to develop and design products. And sometimes when you're doing the market research, you ask a question of what's your income, what's your monthly income, what's your daily income, and even when we remove the question of banks, because yes, banks are probably there's a cost of not only the monthly fee but also the withdrawal fee. For some of the accounts, maybe the monthly fee may not be there, but if you put your money, you have to remove it at some point. There's a withdrawal fee. Even if you use the ATM, there's still some aspect of the fee. But even thinking about the mobile money access, there's a fee for transacting, sending the money to the account. There's a fee for withdrawing. If you need to pay for something, there's a fee that's charged. So for some people, when you hear that someone is earning $1.25 per day, and you try and compute the charges, then you see that for some of them, as much as we want to really bank everyone, it doesn't make any financial sense for them, because that money, when they add it up on a monthly basis, they tell you, with this money that I'm being charged as I transact my money, this money would have paid X or X for in terms of my expenses. And so I'd rather transact in cash. So I think that's also something for the sector to consider in terms of looking at the 1.6 billion and trying to bank everyone, which may not really be possible. But just thinking about the barriers that, Xavier, you've posed the question about the barriers. What kind of barriers are there today as opposed to a few years ago? I think we've already mentioned a bit of them on the call. There's one that's been mentioned about probably providers not really understanding the market, not developing products that really suit the market. I think that was a barrier a few years ago. It still is a barrier, but I don't feel like it's a barrier so much now, because we've got a lot of financial institutions, a lot of non-bank financial institutions also, who have really gone out of their way to understand the market. And a perfect example, I think, is M-Pesa, because if you look at M-Pesa's trajectory in terms of where they started and what they've built on top of the original product, it just shows that they really understand the customer segment, M-Pesa in Kenya. And so there's that sort of barrier that was there maybe 10 years ago in terms of financial institutions, non-bank financial institutions seeing the market as a homogeneous group. I think there's much more understanding that it's more of a heterogeneous group, and you can't really fit one product to the whole market. I think we've also talked about the issue of trust. I feel like it was really an issue several years ago. It still is an issue for some segments of the market, but I think comparatively now it's less of an issue. People still mistrust financial institutions, but not to the degree they were maybe 10, 12 years ago, 20 years ago, when there were all these different sort of charges and there was no sort of transparency in terms of information. Like, banks were not really forthcoming with information. Like, if you put your money, there's a monthly charge, there's this sort of charge. But now increasingly, because of the regulators' push, because of other agencies' push, we're seeing that a lot of the financial institutions are much more transparent. And so customers really understand that if I open an account, these are the charges. As much as sometimes there's still that issue about consumer protection and the people not really understanding everything, I think it's less of an issue now than it was in the past. I think the issue now is mostly about sustained usage of financial services, because as much as we are saying financial inclusion and we are mentioning the numbers of 1.6 billion, which has come down from 3 billion, the measure is what we've sort of mentioned, that we really want to measure this in a more sustained way. So not only talking about the numbers, but also just looking at, so what, beyond the numbers. These customers are accessing the financial products. They're using the loans, they're using the savings products, they're using the insurance products. But are they really changing their lives? Like, what's the outcome of that sort of usage? So I think that's still something that the industry doesn't really understand. Some institutions understand it, but the information is not really really open and accessible to all. And then, of course, in terms of barriers, there's still problems of understanding. So for some products like insurance, the uptake, the usage of that is really low because people don't really understand it. Yeah, I'll stop there.
Yes,
maybe
Brian?
as sort of we've been in the market for probably the longest, close, as I said, to 20 years. I think, Grace, you've touched on a number of issues. I don't think one can ignore the regulatory KYC issues as a barrier. understanding the needs of the marketplace critical, the motivation to have a bank account, the costs that are involved in having such an account. Let's not ignore the change in behavior. People don't like change. Most people. How do you get people to change their behavior? I'm sick of using the analogy because all of us have got children. How do you change the behavior of your child? Very simply, one of two ways: reward or punishment. And I don't mean to offend the psychologists, but you can work that out in your own particular heads. I do think that the next major wave is going to be on the acquiring side. We've focused a lot on the issuing side, but if I sign up all these billions of people, hundreds of millions of people with digital accounts, they need to have somewhere to use it. I can't go to the corner store and they say, well, sorry, I don't accept this digital channel of payment. So I think the next major wave is on the acquiring. It's understanding the SMEs, so to connect all the dots and come full circle. I'm not sure that the small merchant is going to want to, or have any desire, or any need to, for that matter, invest in a point of sale device when they've got a mobile phone. Why is this not a point of sale device? I said it 20 years ago. I guess I'm going to go to my grave still saying it. It's there. It does everything that is required to be done. And eventually, and again, due to this pandemic, it's accelerating it. Somebody used the word earlier. It's accelerating. So this whole concept of tap to pay for e-commerce, soft POS, utilizing the technology that is around on an acquiring basis. I think the next major wave is going to be around chat banking because it's intuitive. I don't know anybody who's gone on any course on how to use Facebook Messenger or WhatsApp. Africa is WhatsApp dominated. Maybe you've been on a course, but I certainly don't know of any courses. It's intuitive. I love these new innovative fintechs that come and say, we're going to change the world with apps. Fantastic, but I think chat banking will leapfrog apps. Apps are very data intensive and you need smartphones. Still today, the latest numbers I got, around 65% of all handsets in Africa are still feature phones, not smartphones. So we need to provide technology that is appropriate to the market and to their needs. But let's not lose sight of the change of behavior, the role of the regulator. I work with regulators. I ran a session for the regulators last week in the Eastern European economy. I don't think any of their intentions is to create barriers to access. At least I've never spoken to a regulator who says our purpose in life is to make it more difficult to bank the unbanked. We were talking about, Rashmi, a risk-based approach that certainly they're relying on the banks to implement. But I think we need to look seriously at trying to ease that access and make it very simple for people to have a low-cost, low-risk bank account. The barriers that were there 20 years ago are still there today.
If I can just add to that and reference, so if we talk about the enabling environment, so CGAP, who all of us know have a great framework in which they look at a number of variables. And if you look at the most recent report, Kenya, which, the birthplace of M-Pesa, and many of us think it is kind of ahead of the game in terms of digital financial inclusion, doesn't even make the top 20. If you look at variables like market entry for e-money issuers and how easy it is for e-money issuers to enter, the existing infrastructure of financial outlets, agents, merchants, that kind of thing. Risk-based due diligence, which is not done widely in Kenya yet, and then consumer protection. So countries like Colombia and India scored very high there, but it was surprising to me to see that Kenya didn't even make the top 20. So I think we need to take a hard look at some of the countries where we might see things like mobile money penetration quite high, but a more comprehensive look at full digital financial inclusion gives us a different picture.
Okay, so I'll try to take, everyone's already said most of what needs to be covered, but a couple of additive points. So if we look a decade ago and where we are today when it comes to financial inclusion, depending on how you define it, a bulk of the numbers came down, and we were at 1.6, largely because of two countries, China and India, and what happened in China and India in the past 7 years. And it's a very interesting in a comparison, because what happened in China was economic transformation. People became wealthier, more industrialized, the smartphone penetration increased. And then suddenly the Chinese regulators and all wake up and say, oh, we need a financial inclusion strategy. We don't have one. Everybody seems to have one. And let's create a deliberate strategy around that. So what happened was they're already here, and as in people are already here, let us build it, because you have the Alibabas, you have the Tencents of the world that were just using their platforms, because internet penetration had also increased, and because of state-owned Chinese banks, which put in this huge, massive cash in, cash out infrastructure, they could just play on top of that. In India, it was very different, because they said, let's create a national ID database, let's have Aadhaar, let's have that fundamental layer, and then start building on top of it, and then people will come in. Very, very different approaches. It is giving results, but also it's not disconnected from economic growth, which still brings us to the question of what are we financing? What is the use of financial inclusion to drive what? And that question will still remain. That's not, so the framing of how we were thinking of financial inclusion has changed. A lot of the regulators in the past 7 years were like, okay, number of bank accounts. Nobody was saying, but most of them are dormant. You've opened all of these welfare accounts with G2P and subsidies and all of that, and call them no frills accounts, because you don't charge account fees, etc., and all types of fancy jargon was used. But at the end of the day, they just ended up being dormant, which is what even initially happened with India when they started this government subsidy programs. Today, what has changed is the framing of financial inclusion. Is it helping better people's lives? And who are the best, and we are not tied into the legacy systems of, oh, they need to be banks. What has happened in the past 7 years is the disaggregation of the entire financial services value chain. It has been broken up into parts. There have been, as Brian mentioned, fintechs who said, we can do payments way better than banks have ever done it. We're going to eat up this part of the value chain. There are others who said, we can do customer and merchant onboarding and acquisition way better than anybody has ever done it. And we're going to take that part of the value chain. So if that value chain is just completely going to be broken up, and there are going to be efficiencies. Of course, there are some challenges as well, because as a bank, if Standard Chartered had provided me everything in my life, there was a certain loyalty that I would have and a comprehensive window that you would have on me, which maybe doesn't exist anymore. My loyalties are split across 5 different brands at this point. So that it's just the customer journey, the supply side, meaning, as well as the policy framing. I feel that those are the things that have changed and will change.
So if I can just also add to that, because obviously the majority of the panelists, obviously you're looking at the customer that's going to consume the product. Obviously we look at the company that is providing that. So the way that we've sort of like identified what barriers that we've got is that, obviously there's a huge population, whether it's 1.6, whether it's 1 million, it's still a very big population of people that are unbanked. So what we find is that even those that can be banked, they've got very limited choice, and they obviously end up paying quite high interest rates. Now, part of that is because the companies that they're borrowing from, whether it be a bank, an MFI, a SACCO, etc., they've got quite high overheads, because generally speaking, because of their legacy systems, especially something like a core banking system. Obviously things like, your T24, your traditional banks, your T24s, it's almost $1 million just to implement T24. So, and then the licensing fees on top of that per year is obviously adding to that overhead. So whilst some organizations out there actually know their customer, they want to offer a better product, they want to offer something that can reach, the other end of the pyramid, they simply can't, because they've got their legacy system. So what we've sort of found, especially with something like our software, because we are totally cloud-based, there's a lot of overhead reduction that comes with partnering with and I'm not just saying your core banking system, but other systems that are cloud-based or internet-based, which can then severely reduce your overhead of, licensing fees, internal servers, if you've still got your internal servers, maintaining those servers, etc. So we sort of look at that where we can sort of like fit into an organization to lower their overheads So they have that ability to grow a different product and to, you know, rather than the time that they were spending, like even data entering, you know, things are now captured out in the field, directly out in the field. You know, similarly to what you guys do, Tula, Hillary with Tula, you know, obviously you capture all of your information digitally, which means that you're then now field agents have got more time to spend in the field, whether it be to, you know, drum up new business, whether it be to educate people, you know, do different trainings, etc. So we definitely see something there where organizations want to do this, but they just can't because of their overhead costs.
Very interesting. Now, if we look at another aspect of financial inclusion, it means what are some of the most exemplary countries regarding financial inclusion? Personally, if I can share some of my ideas, one of the biggest example for me at the moment is India. In terms of number of population, with the Prime Minister Modi with his strategy to raise the country at a high level, and the deployment of a new finance law with a plan to implement a cashless facility with fintech solution, and of course set up a financial inclusion solution. What is your opinion or your experience to each of one?
Good question. And just to give some brief answers, I think those that have obviously no unbanked people are the ones that have been very successful. How have they done it? I think the common factors: government support, change of behavior. There's a disincentive to use cash, a very deliberate strategy to remove cash from society. And that's got to happen. And it's got to happen from government level to say, we are not going to accept cash for payment of services. We are not going to disperse cash for grants, social welfare, pension, or anything else. We are only going to disperse it digitally. And when you've got that coming from the top, behavior will change and suddenly things will start to happen. So to me, you look at those countries where government have got actively involved and you've found support. If you go to some of the countries, Norway, Sweden, Denmark, it's actually very difficult to spend cash, very difficult. Now you might be arguing that we're talking about emerging markets. You're talking about successful factors, those that have been successful. I look at Honduras, a small market, that very soon will be removing cash from society and will become a cashless society. Therefore, by definition, everybody needs to be included. One of the Indian Ocean islands has got a strategy. They want to be the first country in the world that is totally cashless and totally digital. New Zealand, I think, are probably one of the most digitally incorporated countries in the world. Australia, very digitally incorporated. Everybody is using it. So it's a process, Xavier. It's not something that is like a light switch that's going to happen. But fundamentally, I keep coming back to it. How do we change people's behavior? Are they going to change on their own, or is it something that is going to be forced? And let's not forget the acquiring side. I can have the greatest digital strategies in the world. I can be Modi in India and say, we're going to be cashless. But if I can't use my digital payments at the local store, it's not going to work.
Brian, sorry, Xavier, if I may challenge you on that a little bit. So are we saying that Germany, which is a very developed country and extremely cash heavy, is a failure by your definition? So that's the first question, because Germans are very protective about the data. Too much digital trails is an invasion of their privacy. They're still very cash heavy as a country. Most customers, as a cultural behavior, would prefer using cash at small stores. So that's one question. The second question is, there needs to be, it's not just behavior change. We also have to realize, where is that change going to come from? For example, a lot of most emerging economies, literacy is a big challenge. what people do, people who are very illiterate, they have numeracy skills. You can look at the color of the cash and tell what is the size of the bill, how expensive that is, and not if you're not very literate. But if you have to do that on a USSD menu, that requires not only some degree of literacy, some degree of financial technology literacy as well, which is something that cash doesn't require you to. So cash just ubiquitously is very intuitive. So if you could shed some light on that, that would be useful.
Yeah, we've never had a problem, and please, I don't mean this flippantly, but if you put some money into a person's digital account, believe me, they will learn very, very quickly how to access that money. So I've never had a problem in teaching anybody about USSD. And it's typically that the children that are not technology afraid, the youth of the market, that will educate the more senior citizens in the market that may resist. I'm certainly not saying Germany has been a failure. I do think if you look at the youth, give them the preference. Do you want to use cash or digital? Every youth that I talk to will say, give me digital.
Yeah, but I still think that the low literacy thing is an issue, especially when it comes to digital, because I remember when mobile banking was still new, agency banking was new, the older people who are not really literate and could not really follow instructions on a mobile phone, what they used to do is go to their nearest agent, because the agents at that time were seen as the ones who really understood what's happening in terms of this mobile banking, agency banking. And we saw like a lot of sharing of pins, which led to a lot of fraud. And then also not only with the agents, but even with the children and family members. So if people are not really able to maintain their financial wallets as they would cash, then this brings that aspect of fraud, because then it means that all the time they're going to be asking for help. And maybe that also is a reason why the uptake or the usage of services is not so high, because there's that reservation, because I don't really understand. And so, well, then I am not going to use the service, because that element of trust we've talked about is also in these digital platforms as well.
If I can just also sort of add there, obviously, you know, we pride ourselves on being digital. You know, but we also look at both avenues. So in terms of like with a digital, if you want everything to go digital, you need flexibility as well. You know, like one of the emerging markets, and I must admit, even my CEO was a bit dubious about my rationale. One of the markets that I see that does financial inclusion quite well, and as I said, this is, you know, obviously, you know, what we observe is Malawi. You know, now don't get me wrong, Malawi is very undigital based. So with our customers in Malawi, we are not tackling their customer. We're actually, first of all, looking at the operations of the business. And we're saying, okay, you're doing your, you know, PPIs still on a piece of paper when you go out to the group. You know, how about you actually capture that directly through the tablet application that we offer? So it's not actually making their customers digital. It's actually about making the business itself, first of all, digital, and then seeing what efficiencies the business can then gain. And then that knock-on effect will hopefully then bring up their customer to then see how the business is going. Because you sometimes feel, I personally sometimes go, especially when people go from nothing to digital, that they try and do everything at once. And it is about that, you know, that graduation and that stepping stone of reviewing your internal processes for an organization and then moving out, you know, to becoming digital. You know, we see it countless times, you know, lots of manual forms, yet they want to offer like a digital platform to their customers, yet the own organization won't actually embrace digital themselves. So it's about ensuring your grassroots are there first and then bridging it out.
Yeah, and just to give an example, Melissa, we've actually also seen it in terms of we'd funded a company that was going to provide an alternative credit scoring bureau for MFIs. And we sort of gave them money because they said the market was there, MFIs were ready to roll this out. But when they went down to the MFIs, what they found was exactly what you're describing. MFIs were still collecting the loan data on the paper physical forms. And so there was no way then that they'd be able to run an alternative credit scoring, because then they'd have to first put the data inside the, automate the data. And so I think in most of these cases, it's taking a step back, as much as the innovations are there and they're ready, but it's also taking a step back, and for some of the institutions, just helping them upscale. Yeah.
Yeah, maybe just to add one thing, building off this discussion and what Grace just mentioned, and also the mention of India. You know, I think one of the greatest steps that Kenya or a lot of other countries could take is to truly have open data systems, which is one of the things that India did, in addition to the ID, having open data systems. Right now, it's very difficult for even me as a consumer to get my M-Pesa data in a way that makes it easy for someone else to use. If I want to take that data and it's my data and I want to bring it to a bank or an MFI, it's not easy to do that. And so I would say that at a regulatory perspective, a key driver in India has been something that is really lacking in other markets, which is open data platforms.
And I think in the region, it will be interesting to see how, because I know Tanzania are implementing some form of interoperability in terms of their mobile money systems, but also bringing other digital players. It will be good to just see how it works. I know that they are interoperable to some degree, but just seeing how this plans out. And I agree that it has to do with regulators being in and giving the support to players in the market, but also players in the market being willing to share information amongst each other, and not really saying this is my customer, let me hold this information, because once I share the information, then it means that the customer has a choice between using my products and the competitors' products.
So I have a question about that, actually, because the interoperability in Tanzania, you know, happened essentially because of regulatory fiat, right? And there was a lot of excitement, right? Finally, there was a market that was going to be interoperable. I don't know of any other markets that have actually done that. And I wonder, you know, was it a fluke? Can we expect to see more markets? Yeah, Rashmi, I can see you probably have the answer to that. But it certainly would go a long way, I think, to easing the friction in these markets.
So in Tanzania, Hillary, it was also larger because market play. So let's take Kenya, Uganda, Tanzania. Kenya, monopoly, mostly monopoly. Uganda, oligopoly, Airtel, MTN. Tanzania, competitive market. So there was a reason. So there were certain conditions, plus market players came together and set industry standards. The regulator was an observer in most of these negotiations to prevent cartel in pricing and scheme-based setting of rules. So, but the market came together because they realized that actually it's a competitive market, and interoperability can increase the volumes and values that are moving through the system. Uganda, FSD Uganda helped put interoperability together, but unlike Tanzania, it was a top-down mandate. The regulator said, all right, folks, you have 3 months, make this happen. We then managed to, you know, push the timeline out, but it didn't happen very well. Also because Uganda didn't have an overarching national payment systems law, which Kenya has, Tanzania has, and now the bill just got passed during COVID. I don't know how we're very efficient during a pandemic. It's very surprising. But it will happen. But the challenge with interoperability in Uganda is still, it's not solving the friction of the movement of money across different wallets. It's still double dipping in terms of pricing, because you can price it in a way such that if you move money, if Hillary's on MTN and I send money to you, you can price it in a way if you were irrespective of network. There are ways to do that. That's what Tanzania was able to effectively do, so that you're not paying double the fee. But Uganda, the pricing is messed up. So there is interoperability, but the pricing is messed up.
Thank you so much for this very interesting point of view. I want to take some question about the audience to share with you. For example, let me check. First question from Stephen. Does access to financial services equate to banked and unbanked?
Yeah, I think we answered that question, that I think in terms of definition, financial inclusion does mean access to financial services and products, however those products may well be defined, be they savings, be they loans, be it microinsurance, be it payment channels. That's what we mean, I think, by financial inclusion.
Xavier, there are a couple questions in here that I saw, mostly for Rashmi, I think, around cryptocurrencies and blockchain that I think could be really interesting. I don't know, Rashmi, if you... Xavier, do you mind if I read one out? I'm gonna go for it. So Rashmi, there's one here for you that says, could decentralized finance be a solution to financial inclusion based on the fact that large volumes of money move in cryptocurrencies and based on the fact that some fintechs give crypto loans without collateral? And is FSD open to working with companies that deal with cryptocurrencies to find a scalable solution to financial inclusion?
Part two of the question is easier. Yes, we're looking at all types of next generation technologies. We're working with the Ministry of ICT in Uganda, which is building Uganda's fourth industrial revolution strategy, including how do we think about digital assets, how do we regulate them, and then what about cryptocurrency, or even dangerous, depending on which side of the equation you are, digital fiat cryptocurrency. So that is an easier answer. There are enough and more experts who know a lot more about this topic than I do. I'm not going to claim I completely understand it. I don't know how it is necessarily going to solve the problem of the clients that somebody like Hillary or Grace talked about, of smallholder farmers. I'm not very entirely convinced of how that exactly is going to be solved. So I'm going to reserve my opinion on that.
I have another question from the audience. From Courage, what are we doing about the blockchain in solving the issue of financial inclusion? Nobody want to answer to
I can
blockchain.
Try. I think like Rashmi,
Blockchain is...
Sorry.
Yes, Grace.
Like Rashmi, I'm not a blockchain expert. I'm not a techie person, but I think in the last couple of years, financial institutions, non-financial institutions have been experimenting with blockchain. I don't think it has gotten to a point where we can see we've seen a real use case. I know there's been work around just trying to figure out, especially in terms of the digital ledgers and transfer of information between different entities. So in terms of payments, especially, that this can be done seamlessly between different entities using blockchain, because it's a block that cannot be changed, and there's also transparency across different parties. So I don't think we've really seen a use case that's come out definitively in terms of financial services, and more so in terms of financial services for the low-income people. I think there's still different experimentations going on, and probably it's just something for us to just follow up on in the coming years.
So I can just follow up with what Grace said. The currency piece is actually more complex and very political, and it treads on sovereignty of nations, etc., which is why I refrain from ever answering that question. But when when it comes to decentralized ledger and the applications of this, for example, one of the things that Uganda is doing and the Uganda Communications Commission is doing is trying to address fraud using decentralized ledger. So SIM card fraud is very prevalent. So they're like, all right, how do we work with the National ID Authority and then see how do we create, use a blockchain to actually, create a system where we can minimize frauds, and there are certain nodes in your chain that have copies of people who have national IDs and how many and whose ID is being registered and information that is being, because you can have up to, I think it is 4 or 5 SIM cards per provider. And sometimes what happens is the way the fraud happens is that when Rashmi goes to an Airtel agent and the agent is pinging the national ID database and tells Rashmi, oh, it didn't work, let me give you another SIM card. But actually the SIM card got registered with my name, and then that SIM card is used to do fraud, which is a big AML CFT concern now in the country. So, they're trying to figure out a blockchain based solution. So that's a non-currency based response.
Thank you. Thank you. A question for Brian from Fortuna. How can we overcome the entry barrier as a fintech wanting to serve the bottom of the pyramid?
Yeah, it's $1 million question, and it's a good one, and we do find.
And you are the winner.
Yeah, it's hard. It really is hard. We came into the market before fintech was even a word. Nobody even. It's a new word, and it's a challenge. And it's a challenge because we work with banks, and banks typically, and I know it's a generalization, have not made good partners. Banks have had a view that if it's worth doing ourselves. Why do we need to bring in a fintech to help us achieve it if it's good and worthwhile doing it? So a lot of the banks have set up their own fin labs and innovation hubs and whatever else to try and react. There's no doubt, however, that there is a role for fintechs. They are not encumbered by baggage and legacy systems. They've got the ability to move quicker and smarter with the best intentions in the world. And I used the example at the beginning. There's not a bank in Honduras that could give the government a solution that they can go live within 21 days. It's just not going to happen. It's not part and parcel of a bank's DNA. So I think it is changing, but for a new entrant to come into the fintech space, you need a lot of guts, you need a lot of courage, you need a huge amount of patience. It always takes longer than you think it's going to take. It's always, the take-up is always a little bit slower than what you thought it was going to take. So patience and perseverance are the 2 Ps that you certainly need in abundance. But hopefully, and I do see it, that banks are responding positively. I think, and I hate to say it, but this pandemic disaster is having a positive impact in transforming change. And if I can use one example, and it's related, I was chatting to a non-banker who happens to sit on the board of a very, very large bank, and he sits on their remuneration committee. He says this is one time when if a bank makes 100 profit, or it makes break even, or it makes a loss, because of the economic conditions, nobody's going to get into trouble or lose their jobs for it. So the only measure they've got in rewarding executives at this particular time is their rate of transformation. Have they used the opportunity and the climate that exists today to transform their organizations? And if not, why not? Because that is the basis on which they're going to get rewarded. So I think due to circumstances that nobody could have predicted 6 months ago, we are seeing an acceleration, and I'm very excited about the opportunities that it comes, particularly the opportunities for the unbanked and the impact that it'll have at the lower end of the pyramid.
Thank you, Brian. I have a question from Aka for Rashmi. How competent are the VSLAs in dealing with the technical problems of measurement and tracking of the project funded? Do you?
Sorry, Xavier, I was looking for the question. I'm not sure I understand it.
Me
Sorry,
too. We are both.
Sorry, who's
Yeah, at the end.
Oh, okay. How competent are VSLAs in dealing with technical problems of measurement and tracking? So do you, of projects that are funded? So VSLAs are like self-funded, and Hillary can help me here. So it's like a village savings and loan group, and it's the members of the group that fund whatever they have to do. So it's not externally funded unless Hillary Grace, am I missing something?
In some cases, they could get external financing injected. In some cases, it's all internal. But I still am I'm a little unclear on the question.
Okay. Yeah, sorry, AK, we don't mean to disregard your question, but we're not sure we completely understood it.
Maybe they can type in more detail.
Yes, we can. If Aka listen to you, we can to be more explicit, please. Sorry, because you have a lot of comments in the same times of question. I try to read. Yeah, a question from Jacqueline. Shouldn't the government provide more avenues to their people so that they can use this digital product? And add a comment, bank accounts are there but largely dormant, so no point of digital product if there is no money being injected into these channels.
Yeah, I mean, I think we have covered it to a degree, and it gets back to the fact that the reason why the accounts are dormant is because we're not meeting the consumer's needs. If we were meeting the consumer's needs, the account would be used. If there were places that they could use their digital accounts, they would use them. But if the only place that they can, or the means that they can transact at the local stores and shops is with cash, they're going to go draw their money out, put it back under the mattress, and it gets back to this whole chicken and egg thing. I think Finscope did a study in South Africa some years back, $12 billion at any one time under mattresses. Now, we were talking about access to funds and building a deposit base. Now, all we need to do is to get percentage of that, and the impact that that has on money supply with the multiplier effect of money and what we can do for the lower end of the market is enormous. But if it's going to stay stuck under mattresses, I'm afraid we'll be having this debate in another 10 years' time with very little impact having been done. So yes, I think government has a role to play. I think private enterprise has a role to play. I think fintechs have a role to play. And I think MFIs and the financial services industry have a role to play. Everyone needs to work together to collaborate, not compete, but to collaborate. The mobile network operators, as we've said, have done a fantastic job. They should be part and parcel of the financial services space. No argument with it at all. And we need to work together to address, to me, this terrible situation of the unbanked. And if I may use one example, in where I live, we have some domestic workers that are unbanked. With this lockdown, their only means of entertainment has been pay TV, DSTV. They cannot get to the shop to pay for their subscription. So their only means of entertainment in this dreadful time of lockdown has been taken away from them. Does anybody sitting here think that is right? Because they cannot get to the Home Affairs Department to renew their permit, and as foreigners, their account is suspended and frozen. Is that right? And I don't care who you are, that on any level is morally and ethically wrong, and it's time we stopped this nonsense. So that's my closing comments.
Thank you, Brian. It's time to conclude now. Thank you very much to all panelists for this interesting insight. I think we learned a lot of things, a lot of debate, a lot of discussion. And I'll let you in one sentence to conclude and provide some ideas or vision to our audience. Melissa?
Javier, you've kind of put us on the spot. I think I'm a little bit under pressure. I'm watching everybody else's face, and we're
No,
like,
because
one
I didn't
sentence?
heard you. This is
Have
the
you not
reason
just
why.
heard most of us? You want one sentence from us?
Oh, maybe you don't have any conclusion.
Look, I just think it's all about collaboration. That's my one sentence, or even just word. Let's collaborate. There we go. Let's collaborate.
Thank you, Melissa. Rashmi?
Invest in digitization for all governments as well as private sector. That's non-negotiable because something of this nature can happen and it's proven. So if you don't build resilience now, you will never build it. You will be extinct, period. And second, for all of us, is this is a time where we have realized that inequality, wealth inequality is just going to become worse. And if we don't do something about it, we will leave a large swath of the population behind. And we need to be very proactive about that.
Thank you, Rashmi.
Yeah, if I can just build on Rashmi's point, I think to go one step further, I would say in particular, we need to be thinking about how to serve women, how to serve rural customers, and how to serve SMEs. And otherwise, that gap is just going to be so much wider for them. And I particularly am bullish on non-bank players like e-commerce and others to close some of the gap.
Thank you, Hilary. Grace?
I think for me, let's figure out the missing ingredient that's missing in terms of financial inclusion and access that makes it not translate to economic empowerment and more economic value for the bottom of the pyramid people. And let's just make the two work together.
Thank you, Grace. Brian?
Yeah, it's been fascinating. I agree 100%. Digital is the way to go. We need to focus on the acquiring side of it, particularly with the small merchants and the small businesses. E-commerce is set to absolutely take over Africa. I am absolutely convinced of it. And there's such an opportunity for us. We need to work together and let's make the most of it. And hopefully in a few years' time, we can sit down and say, we have actually made a difference.
Thank you very much to all of us. And on behalf of Finovation World, I give you the next webinar on 17 June about banking, AI, and blockchain. And again, thank you very much to our dear panelists. Take care and have a nice business. Thank you. Bye-bye.
Thank you.